Imagine waking up one morning and realizing your money is no longer just sitting in an account waiting to be spent. Instead, it is quietly working for you, sending income into your life while you sleep, while you eat breakfast, and while you go about your day. For many people, financial freedom feels like a distant dream, something reserved for the wealthy, the lucky, or the people who started investing decades ago. But there is another path that often gets overlooked: living on investment dividends. Some people think about retirement by looking at reverse mortgages, selling personal possessions, downsizing their home, or moving somewhere cheaper. Those options may work for some, but dividends offer a different idea. They allow your investments to create income without forcing you to sell the assets themselves. In this story, we will follow John. His goal is simple and powerful. He wants to earn $2,900 per month from dividends. That equals about $35,000 per year. But before John can reach that number, he has to understand that the perfect investment amount is not the same for everyone. It depends on lifestyle, comfort level, expenses, and the kind of future a person wants to build. Some people spend far more than $35,000 per year. Others can live happily on less. The real question is not just how much dividend income John can create. The real question is what kind of life that income can support. Before John can build a life around dividends, he needs to understand what a dividend actually is. Imagine he owns shares of a company. That means he is not just watching the company from the outside. In a small way, he is one of its owners. When that company earns a profit, it has choices. It can use the money to grow the business, open new locations, build new products, or strengthen its future. But it can also decide to share part of that profit with shareholders. When a company gives part of its earnings back to the people who own its stock, that payment is called a dividend. For John, this is where the idea becomes exciting. He does not have to sell his shares to receive money. If the company pays dividends, he can receive income simply because he owns the stock. That payment may arrive as cash through a digital deposit. In some cases, it may come as a check, or John can reinvest those dividends by using the money to buy more shares. Many dividend-paying companies send these payments every 3 months. That means John could receive income on a regular schedule, not by working extra hours, but by owning assets that share profits with him. Now that John understands what dividends are, he needs to learn one number that can change the way he sees every dividend investment. That number is dividend yield. Dividend yield shows how much income an investment pays compared to the price of the stock. It helps John understand whether a stock is producing enough income to match his goal, or whether he would need a much larger portfolio to make the numbers work. The formula is simple. Take the annual dividend per share and divide it by the stock price per share. For example, if John buys a stock that costs $100 per share, and that stock pays $10 in dividends over 1 year, the dividend yield is 10%. This matters because John is not just trying to own stocks. He is trying to build income. He wants those investments to send him money without forcing him to sell the shares. If the yield is too low, he may need a much larger portfolio. If the yield is higher, he may reach his income goal with less capital, although he must also understand the risks. And this is where the journey becomes real. If John wants $2,900 every month, he cannot just dream about passive income. He has to calculate it, compare investments, and ask himself one serious question. How much money would he need invested today to make dividends replace part of his paycheck tomorrow? The first strategy John can look at is one of the fastest ways to create dividend income: covered call ETFs. At first, the name may sound complicated, but the idea is easier to understand when you slow it down. A covered call ETF is a fund that invests in stocks, but it also uses a second income strategy. It sells call options on some of the stocks inside the fund. A call option gives another investor the right, but not the obligation, to buy a stock at a specific price within a certain period of time. When the ETF sells that option, it receives money up front. That money is called premium income. For investors like John, that premium income can help create larger payouts. This is what makes covered call ETFs attractive. They do not rely only on regular dividends from stocks. They can also generate income from the options they sell. So instead of waiting only for companies to distribute profits, John may receive income from two sources: the dividends inside the fund and the option premiums created by the strategy. If the stock price rises above the option's strike price, the ETF may have to sell those shares. That can create capital gains, but it can also limit some upside. Still, for someone focused on income, the appeal is clear. Covered call ETFs are designed to produce cash flow, and that is exactly what John is looking for. Now let's bring this strategy into John's actual goal. He does not want dividend income as a vague idea. He wants a real number, $2,900 per month, or about $35,000 per year. Some covered call ETFs have offered very attractive yields, often in the double digits. Examples include XYLD, OILK, and EWZ. Based on their 12-month trailing yields, XYLD has a yield of 11.83%, OILK has a yield of 11.82%, and EWZ has a yield of 11.81%. Those numbers are powerful because they change the amount of money John needs to invest. With traditional dividend stocks, reaching $35,000 per year could require around $2 million invested. For most people, that number feels almost impossible, but with covered call ETFs, the math looks very different. Based on those yield levels, John may need roughly $280,000 to $310,000 invested to generate about $35,000 per year in dividend income. Compared to $2 million, that is a much smaller mountain. Still, John has to be careful. Higher income does not mean zero risk. Options can expire worthless. Stock prices can fall. Fund performance can change over time. But if John understands the risks, covered call ETFs could give him a faster path toward the income he wants without requiring an enormous portfolio from the beginning. The second strategy John can explore is high-yield REITs. REIT stands for Real Estate Investment Trust. Instead of buying an entire building himself, John can invest in companies that own or finance real estate. These real estate companies may be connected to malls, office buildings, apartments, or other property assets. They earn money from those properties, then share part of that income with investors through dividends. For someone like John, this can be attractive because it gives him access to real estate income without forcing him to become a landlord. There are several REITs that may catch John's attention because of their high dividend yields. Two Harbors Investment Corporation has a dividend yield of 20.3%. Brandywine Realty Trust has a dividend yield of 19.9%. Orchid Island Capital Incorporated offers a dividend yield of 19.4%. On paper, those numbers look extremely powerful. If John is trying to reach $2,900 per month, a higher yield can make the goal feel much closer. Instead of waiting decades to build a massive portfolio, REITs may help him create income faster. But John also has to understand what those yields really mean. REIT income depends on properties, tenants, rent payments, and the broader economy. When the economy is strong, REITs can feel like a powerful income machine. But when the economy weakens, rents, property values, and investor confidence can all be affected. So the question John has to ask himself is not only how much income a REIT can pay today. The deeper question is this: can that income remain steady when the real estate market faces pressure? For John, REITs are not just about chasing a high dividend number. They are about building a plan. Historically, REITs have shown solid performance, with an average annual return of about 10.8% over the past 20 years. That means REITs may give John two things at the same time: the chance to earn steady income and the possibility of growing his wealth over time. But the income is not guaranteed. The amount John receives can rise or fall depending on how the properties perform. If tenants keep paying rent, buildings stay occupied, and the economy remains strong, REITs can produce reliable cash flow. But if vacancies rise, property income falls, or the economy weakens, those dividends can come under pressure. So how much would John need to invest to earn $35,000 per year from REITs? If he expects around 10.8% per year, he would need roughly $320,000 invested. That number can change depending on whether he spreads his money across different REITs or puts too much into one place. A smart path for John is not to rush. He can save and invest a set amount every week, let the dividends build, and stay consistent until his portfolio reaches the income level he wants. If he remains committed and patient, this kind of approach could help him move toward financial independence in about 5 to 7 years. And because many REITs pay dividends every month, they can feel especially attractive for someone who wants regular income from the stock market. For John, this strategy could turn the dream of living off dividends into something much more practical. The third strategy John can consider is dividend aristocrats. These are special stocks from companies in the S&P 500 that have increased their dividend payments to shareholders for at least 25 years in a row. That track record matters because John is not only looking for income today, he is looking for income he can trust over time. A high yield may look exciting, but if the dividend disappears, the plan can fall apart. Dividend aristocrats are attractive because they are known for consistency. These companies have continued raising dividends through different markets, different economic cycles, and different business conditions. Some examples include 3M, Leggett and Platt, and Walgreens Boots Alliance. On average, these companies pay close to a 7% dividend yield. That is lower than the covered call ETFs and lower than the high-yield rate examples John saw earlier. But the trade-off is stability. These companies are usually well-established, large, and mature. They often have long histories of generating profits and returning money to shareholders. Dividend aristocrats also come from different industries, which can help John avoid putting all his money in one type of business. That matters because every investment has risk. A company can face weaker sales, changing competition, or pressure from the economy. But by spreading his money across multiple dividend aristocrats, John may reduce the damage if one company struggles. For John, this strategy is not about the fastest possible payout. It is about building a dividend foundation that may feel more reliable, more predictable, and easier to hold through uncertain times. So how much would John need to invest if he used dividend aristocrats to reach his goal of $2,900 per month? With an estimated dividend yield close to 7%, John would need about $500,000 invested to become fully independent from that income stream. At first, $500,000 sounds like a huge amount of money, but compared to the $2 million that might be needed with traditional dividend stocks, it is still only a fraction of the capital required to produce the same $35,000 per year in dividend income. The smartest move for John is not to depend on one company, one stock, or one idea. A better approach is to spread his investments across multiple dividend aristocrats. That can help reduce risk and give his portfolio a stronger foundation. These companies have a long record of increasing dividends, and their connection to the S&P 500 adds another layer of credibility to their performance. Now, John has three possible paths in front of him. Covered call ETFs may help him reach income faster with less capital, but they come with risks tied to options and market movement. High-yield REITs may offer powerful income potential and monthly payouts, but they depend on real estate, tenants, and the economy. Dividend aristocrats may offer lower yields, but they bring consistency, history, and long-term discipline. So the real question is this: would you rather chase faster income with more risk or build slower income with more stability? For John, living off dividends is not just about one perfect investment. It is about knowing the numbers, understanding the risks, and choosing a strategy that fits the life he wants to build. If he stays patient, consistent, and focused, dividend income can become more than a dream. It can become the foundation of financial independence.